Well, the strong Aussie dollar, a robust labour market and the RBA in tightening mode all seem to be reasons why some large bond investors, even to add more exposure to the market in the long run. Let's take a look at the fixed income space now with Stephen Nash, who joins us in the studio from Fixed Securities. Carson's with Bill as well. And Stephen, you're, as everyone else is, very closely watching these RBA minutes today. We had that hawkish tone coming from the RBA in the lead up to the last board meeting.
Yeah. It
didn't deliver the hype. What do you think is going to be the key?
Well, I think the concern about the global outlook, I think is probably a key consideration here. Maybe also some comments regarding how this lower growth outlook globally will affect emerging markets, for example, China and India. Maybe there's a possibility of some notching down of expectations with regard to those growth numbers.
Mm-hmm. It's very interesting as well, the attitude that the Reserve Bank has when it comes to the US. I mean, not just on the economic front, but when it comes to buying its debt. I only say this because we're just getting a flash on the wires from saying that indeed we've now pared our holdings of US Treasuries by about a quarter to the lowest level since '09. And this is as global central banks, reserve banks, including China, only continue to add to their holdings. What do you make of that?
Look, I don't think it's sending any signal at all in terms of what the RBA feels about treasuries at this point. Obviously, they're low, and they're low for a very good reason. I think the economic outlook is quite poor.
But these are long-dated US bonds. No worries about the short term. No doubt about that. But it's the longer-term profile.
Yeah, the 30-year bond. 30-year 10-year spread has been widening over the last month or so with concerns about longer-term inflation. The 10-year bond, as you know, is quite low, towards the 2.5% level. I think it could probably hit that 2.25 level at some stage. But the lingering concerns with inflation are affecting that 30-year area. The question would be, I suppose, will that continue? I suppose that really depends on the trajectory of growth, and I imagine that will be quite flat. So I imagine that eventually people start buying those 30 years and tightening that spread, but it'll take a while for that perception to develop. Yeah.
But those indications on inflation, maybe even deflation, I mean, they're coming directly from Ben Bernanke at the moment, aren't they, in the latest speech?
Yeah, the latest speech did emphasise that unemployment is too high and inflation is too low. There was quite strong emphasis on that, and I think also the general perception from that speech is that they're not viewing unemployment as structural. It's something that they can impact with monetary policy. And there's been some comments recently as well supporting that idea, so that they really have to get aggressive now and try to stimulate the economy. There are some lessons from Japan. I mean, Japan showed that if you're too hesitant with regard to stimulation, you can get it into a very difficult situation.
The point is, though, in a sense, yes, jobs are important, and they are everything. And it's also, though, even if you get a job, you're not going to see the spending just kicking in overnight. It's 70% of US GDP. Yeah. Now, without it, you don't obviously go anywhere but muddle through, if not go backwards. So what are we talking about in terms of a timeline?
In terms of growth?
Well, indeed. Assuming you do bring those unemployment numbers down through this QE2, then what's the path out of it?
Hopefully towards the end of 2011 we can see some moderation towards 7.5% maybe in terms of unemployment in the US. But again, that's going to be quite long. Yeah, that's quite.
You're calling the 7. Do you think a move downwards to that level is possible?
Look, depending on the aggressiveness of the Fed move, and I think they will be quite aggressive, but the market has built a lot in. We've been talking about QE2 for a long time now. I think bonds have probably rallied a little bit too much, and equities have rallied a little bit too much. And there needs to be some correction, but I imagine that the general attitude within the Fed will be to get aggressive and not fool around with this and really make sure that they stimulate growth.
It does make that eventual exit even harder, though. It's even amazing that it was about a year ago we were already talking about an exit, and now you're saying they're going to go in really aggressively. I find that amazing.
Yeah, the exit is another problem. I think right now they've got to fix the unemployment structure, not the structural but the cyclical nature of this unemployment. And that's not the issue right now. They've really got a problem with growth, and they've got to fix that. as soon as possible.
Are we though putting too much store on what the Fed can actually achieve without a response from the fiscal side of the fence as well? And a president's hands look like they'll be tied. It's like it's a push and pull.
Yes, they will definitely need more from the fiscal side as well.
But they can't afford to cut taxes. That's the problem. They need payroll. They need these states to balance their books.
Well, the issue will be around early November with these elections, whether the president, has a lot of difficulty with the House and the Senate as a result of those elections. Now, yes, if they don't support him in terms of the fiscal side, then monetary stimulation has to be that much bigger. And there really has to be both at once,
And then just to feed it back into the RBA and our own situation in Australia, I mean, this all gets decided perhaps just a day and a half after the next RBA meeting, which I guess...
Yes, I think that's a very important point because, we've got a lot of issues that emerged just after that meeting, and I imagine that the RBA will, given its caution so far, probably carry that through into the November meeting.
Would they have some sort of information or some sort of information gathering in terms of trying to get an idea of the size of it, or...?
I'm sure that they're well informed, but, I imagine that, they haven't got the full details and that, like everyone else, they'll have to see those and also evaluate those.
Is it time also, Stephen, to be talking about life after Ben Bernanke? In other words, to believe that potentially if Obama does not win a second term, that Republicans might actually want to see the back of Ben Bernanke? And if so, who might take his place?
Well, that's a very, very difficult question. I just talk about Peter Diamond getting on the Fed at the moment. That's not a sure thing.
It's just been so interesting to see that the number of different voices around that table that clearly have massively different views.
Well, you can see the debate within the Fed. Evans and others, they're coming to the press and they're speaking. There's a lot of debate there, and it's good to see, I suppose. This is just one indication. The Evans talk about targeting inflation. That's only one indication of obviously an ongoing discussion within the Fed, and they've got a very serious and very, very challenging job ahead of them.
Stephen, we have to wrap up for now. We could always go through much more, but thanks so much for today. Thank you.
Cheers.
Stephen there from Fix Security.